to really restructure itself, which so many people want. The investment opportunity right now, well, look, let's get beyond, say, the trading opportunities, okay? And let's just say that what is not going to go away immediately is this environment of very weak global growth, excess supply of just about everything globally. We're still in a deflationary overall climate. And what that means is that central banks keep their foot in the accelerator, interest rates stay close to zero, bond yields go down even further, and it means you want to basically be engaged in the capital markets in that yield at a reasonable price mentality. You want to focus on income, relatively safe income where you can get it.
So what does it mean for the Canadian housing market? We've seen other studies saying that if central banks stay very, very easy, that just means further heights for the Canadian housing market. Let's start there. Or do you see any reason for it to take a step back?
Well, when people ask about Canadian housing, they're really talking about Toronto and Vancouver, which is a third of the market.
Do you own two houses in Toronto?
Well, I wish I did, and if I did, I'd be selling one right now.
Why? So, why would you sell one right now?
Well, because you'd be massively overweight. It's called, in investment parlance, rebalancing. Okay, you don't have two overly expensive assets, especially in the same asset class.
But so not because you see something around the corner for the market stepping back.
Well, look, at some point, it's the old Newtonian first law of motion. The body of motion will stay in motion until some countervailing force causes the motion to change. The housing markets in Toronto, Vancouver specifically are unsustainable. Okay, at some point, there will be some mean reversion. I'm not saying it's around the corner. But the markets are extremely expensive. Now, it's not going to be interest rates because the Bank of Canada is not going to raise interest rates and have the Canadian dollar start to rally and impede progress in the manufacturing sector. There's no need for that. But I think what we're going to find is that, up until now, when you think about CMHC, and this is talking about credit rationing, tightening eligibility criteria, so on and so forth, they've been really operating with a wrench. The question is, will they come out with a hammer at some point? Or will the government come in and now that they've started to identify that there's some speculative behavior in these high-priced markets, will the federal government come in with some sort of tax, say, on if you flip your property within 12 months?
It sort of sounds like they're moving towards, some sort of measures, right? I mean...
Well, it sounds like they are, but remember, we're talking about really two markets that are in overheated terrain. Vancouver's an outright bubble, everybody knows that. So it's not the overall Canadian housing market, but, my sense is that you can either do it through interest rates, which they won't, or they'll do it through credit rationing, which the CMHC's already done. I think they're just amazed at the measures they've taken. Hasn't really had much of an impact yet.
I know, absolutely the opposite of a debt